So it's important to think of capitalism as a dynamic and evolving set of concepts that has changed over time, all the way from the original charter companies through to limited liability companies through to the current electronic stock exchanges that we see around the world. An important evolution in the last couple of decades has been a recognition of externalities. So the fact that the market can have positive and negative impacts on both society and the environment, and specifically that we live in a world where we recognize the interconnectivity of the biophysical system, the social system, and the market system. And this is probably one of the biggest and most important evolutions in the capitalist system right now, and it points us towards an economic growth path that is low carbon, resource efficient, and socially inclusive. So I would say that historically the markets have traditionally not considered impact. Most providers of capital towards solving for impact outcomes have traditionally been grant funders. And certainly in that world, historically, there's been this acceptance that you would give away your capital to achieve some sort of impact outcome. I think we are in a world where we are increasingly trying to solve for risk, return, and impact outcomes. And certainly within that triangulation, there will be natural trade-offs. Whether it's across asset classes, sectors, or geographies. So the important part of this question is really to think about impact. From where we're sitting, we think of impact as both direct, real-world impact, as well as harm reduction. How one can access impact varies across liquid and illiquid strategies, as well as sectors and geographies. So that's an important concept to remember. However, the starting point of solving for this at an investor level is for the investors to be clear around what are the issues that are material to them from an impact perspective, whether it's climate change, whether it's economic resource efficiency, whether it's gender issues, whether it's education or healthcare issues. Once an investor has those issues in mind, the next step is to think about the risk-return time horizon and what is practically achievable over a 1, 3, 5, and maybe even 10-year basis. And from there, we're in a world right now where there is a plethora of investment opportunities out there, both in the listed and in the liquid environment. And from there, investors can build up a portfolio that delivers an appropriate risk-adjusted as well as impact-orientated portfolio.